Welcome back to the Deep Dive. Today we are strapping in for a high-altitude analysis of Archer Aviation, ticker ACHR. Specifically, we're tearing into their Q3 2025 financial results call. It was quite an event, held after hours, back on November 6th.
Oh, it was a blockbuster. And I think that's the right word, because this call was the absolute definition of a split narrative.
How so?
Well, on one hand, management unveiled this huge, vertically integrated vision for urban air mobility. I mean, they're building the aircraft, they're buying airports, they're developing their own AI. It was a huge statement of ambition.
But the market reaction was not ambitious. It was brutal.
Exactly. We saw this sell-off that just seemed to completely ignore that vision and focus on two things: dilution and this incredibly long road to profitability.
So that's our mission today. We're going to give you the shortcut. We'll unpack the numbers, the big acquisitions, the regulatory clock, all of it, so you know exactly why the stock is such a battleground right now.
We'll start with the headline figures, but definitely stick with us because the real story is, buried in all the nuance.
Okay, let's do it. Financial snapshot. The number that kicked it all off was the GAAP diluted earnings per share.
Right. That came in at a loss of 20 cents.
20 cents. And that was actually an EPS beat, right?
It was a beat, yeah. A modest one, but a definite beat. The street consensus was looking for a loss somewhere between, say, 24 and 30 cents. So a nice little surprise to the upside there.
Okay, so that's the good news.
That's the good news. But as soon as you dig in, the signals get, well, very contradictory. The net loss for the quarter was $129.9 million.
Right.
Now, this is crucial. While it was a $76 million improvement from Q2, it was still a higher loss than a year ago.
Wait, okay, let's pause on that. A $76 million sequential improvement. If they're burning cash like crazy, how did the loss actually look better than the last quarter?
That is the perfect question. That improvement was almost all from non-cash adjustments. So the underlying operational cash burn, the money actually going out the door, that stayed very robust.
So for a company like Archer that isn't making money yet, the GAAP numbers can be a bit misleading.
Very misleading. You have to focus on the operational losses.
And speaking of not making money, revenue was exactly zero. Flat year over year.
Yep. And while we all know they're pre-commercial, some analysts had modeled, a tiny token amount, maybe $400,000 or so, maybe from a defense milestone. So technically, that was a tiny miss.
Okay, so what about adjusted EBITDA?
That landed at a loss of $116.1 million. The good news is that was right inside the company's own guidance range.
But the bad news?
The bad news is it was still worse than the loss from last year's Q3, which was around $93 million.
So to sum it up, we have an EPS beat, a technical revenue miss, and a rising annual loss that, okay, stayed within their guidance. What did the market do with all that?
The reaction was swift, and it was negative. Despite the EPS beat, shares closed the next day down almost 8%, and on incredibly heavy volume.
So this wasn't just a few people selling.
No. This was the market sending a very clear signal that the big strategic announcements that came with those numbers were just too risky or maybe too expensive.
And that leads us right into the heart of this, the balance sheet move that completely dominated the call.
It was a thunderclap. Archer announced a $650 million registered direct equity offering.
Wow.
They sold over 81 million shares at $8 a share. And this move boosted their total liquidity, their cash on hand, to over $2 billion.
$2 billion.
And management was forceful on the call. They framed this as sector-leading and a core strategic advantage. They see this $2 billion as a war chest, what they need to build out the entire ecosystem.
But you just said the market punished them with an 8% drop. If they have a $2 billion core strategic advantage, why did investors immediately sell?
And that is the narrative disconnect. The market sees that $650 million as major dilution happening right now, today, while the advantage of that $2 billion is realized, years from now.
It's a trade-off.
It's a classic high-stakes trade-off. They bought short-term pain for long-term security. The big question for you as an investor is whether that security is worth the immediate cost to your share price.
So where is all that fresh cash going? The biggest piece was this concrete acquisition, the Hawthorne Airport deal in LA.
Yeah, this is the moment Archer goes from just an aircraft maker to an infrastructure developer. They spent $126 million cash on this airport, and that's just part of a $171 million total they've earmarked for the whole thing.
A pre-revenue startup is buying an 80-acre airport 3 miles from LAX. That feels less like a tech play and more like a huge, expensive real estate bet.
They're signaling total vertical integration. They want control. Hawthorne is right near SoFi Stadium, the Intuit Dome, major traffic generators. Their plan is for it to be the main hub for the LA air taxi network right before the LA28 Olympics.
So it's not just an airport, it's a future center of gravity for them.
Exactly. But they also see it as a live test bed for their AI-powered platforms for both air and ground operations.
So by owning it, they control everything.
Everything. The user experience, the charging, the turnaround times, the software stack, all without relying on third parties. That, they argue, is the structural advantage that sets them apart. They own the choke point.
Okay, so that's the concrete side. But they also made a big move on the code side, expanding their IP.
Yes, very strategic. Archer closed a deal to acquire about 300 patents from Lilium. It cost them about 18 million euros.
And what do these patents cover?
Critical stuff. Ducted fans, high voltage systems. And this pushes their whole global IP portfolio to over 1,000 assets.
Why are those specific patents so important right now?
Well, it's both a defensive and an offensive play. Defensively, it makes them harder to sue. Offensively, management said they're going to leverage this for future platforms, especially for defense. And this is where we have to talk about a key regulatory idea, the OMSAIC rule.
Okay, let's quickly define that.
Right. OMSAIC stands for Modernization of Special Airworthiness Certificates. It's this coming change from the FAA that could totally change how light modern aircraft get certified.
Yeah.
Archer is betting that having all this IP now lets them move fast and adapt new platforms once Mosaic creates that regulatory clarity in a few years.
That's a great connection. Okay, let's talk about the plane itself, the Midnight. Where are they with certification?
The flight tests are hitting some really key milestones. The piloted Midnight has hit a 55-mile range, 10,000 feet of altitude, and speeds over 126 miles an hour. Management even hinted at over 150.
And crucially for flying over cities.
It was described as remarkably quiet. That's huge for community acceptance.
Absolutely. But speed doesn't matter without the FAA's blessing. What's the timeline look like?
It's still very aggressive. They're targeting FAA type certification as early as Q3 2026. But the most immediate, the most crucial milestone is starting the Type Inspection Authorization Campaign, the TIA.
TIA.
And the team is close. They're potentially aiming to start that by the end of this year.
So for the listener who doesn't follow FAA procedures, what does starting TIA actually mean?
It's the moment the regulatory rubber meets the road. Up until now, the FAA has mostly been looking at documents, at test plans. When TIA starts, FAA officials are physically there, witnessing and auditing the flight performance to make sure it meets every single standard. It's the gate to the final certification phase. It's the biggest thing on their schedule.
That makes the stakes crystal clear. Okay, let's pivot to their commercial momentum, which seems to be picking up globally.
Yeah, the global strategy is really impressive. In the UAE, they're making progress, securing their first seven-figure milestone payments. We won't see that as revenue until 2026, but the cash is coming in. And UAE regulators are also targeting a mid-decade approval.
And Asia Pacific, which is a massive market for this.
Huge. They signed an exclusive partnership with Korean Air for up to 100 aircraft. And their consortium, with big players like JAL and Sumitomo, was picked for projects in both Osaka and Tokyo. That instantly puts them at the front of the line in two of the most complex urban markets in the world.
And then there's the defense diversification, a way to get some earlier revenue, maybe.
It's a very smart de-risking move. They're licensing their electric powertrain to companies like Anduril for drones like the Oman drone. They're also starting a sandbox partnership in Saudi Arabia. This is all about planting seeds for potentially higher margin, earlier revenue streams using their core tech.
Okay, let's bring it back to that $2 billion war chest. How fast are they actually burning through that cash?
Third-party analysis puts their quarterly cash burn, and that's operations plus capital spending like building out facilities, at roughly $125 to $130 million. That's the ticking clock.
So with $2 billion in hand, $130 million a quarter gives them a runway of over 4 years.
Exactly. And that's why management calls it a strategic advantage. It buys them the time they need to hit all these regulatory and infrastructure milestones without having to run back to nervous investors every 6 months.
And that's reflected in their guidance.
Precisely. For Q4, they guided the adjusted EBITDA loss to between 110 and 140 million. And remember, that number doesn't include the funding for the Lilium and Hawthorne deals. They reiterated first revenue in early 2026, but the break-even point is still way out there. They're targeting the 2028 to 2029 timeframe.
And that 2028-2029 timeframe, that has to be the source of the market's anxiety. That is a very long time to be cash flow negative.
It is. And that long timeline is what amplified the reaction to the dilution. That 8% drop happened on massive volume, around 154 million shares traded, more than double the day before. It was a high-conviction sell-off.
It really does sound like the sell-off was driven almost purely by that financing risk, just ignoring the strategic moves they made.
That's the disconnect in a nutshell. Management sees a multi-use platform for passengers, defense, logistics. They see unique assets. The market saw 81 million new shares hitting the books and immediately repriced the risk.
And we can't ignore the legal risk that popped up right after the call.
That's right. Shortly after the call, Joby Aviation filed a trade secrets lawsuit against Archer. That adds an immediate, expensive, and unpredictable legal problem to an already sensitive story.
But there has to be a counterpoint. Not everyone was selling on the news.
Absolutely not. And the counterpoint is a big one. Major growth investors, specifically ARK Invest, saw that drop not as a warning, but as a buying opportunity. They picked up roughly 3 million shares.
So they see this as a good entry point.
It signals that some of the big players on the buy side see this as a dip in what they believe is a category-defining industry, an industry that just requires a massive amount of upfront capital.
So what we have is a classic high-risk, high-beta bet on execution and future regulatory success. The next 6 quarters are just packed with high-stakes catalysts.
It's a dense map. We have to watch Q4 results. We need to see the successful start of that TIA campaign. And we need to see how they actually start using Hawthorne. If they hit those, the narrative can shift very, very fast.
Which brings us perfectly to our final segment based on all this tension and volatility.
This is not financial advice.
The market is punishing Archer for the dilution they needed, driving the stock near what some chart watchers see as a key support level, around $5.50. Given the volatility, the liquidity, and the long time until break-even, here's an outrageous but plausible trade idea.
So the trade itself is a bullish, long-dated options play, specifically buying call spreads that expire way out in mid to late 2026, or maybe even 2027.
Okay, so what makes that plausible?
The plausible part rests completely on that $2 billion liquidity buffer. It shields the company through the immediate cash burn and lets them focus on hitting those critical regulatory milestones we talked about, like starting the TIA campaign and getting real traction at Hawthorne for the LA28 Olympics.
So you're betting that the pain of dilution today gets erased by the clarity of regulation tomorrow.
Exactly. If they hit those certification milestones on time, the value of their infrastructure and their IP could suddenly unlock a really strong re-rating from Wall Street. You could see the stock move back toward those analyst price targets in the $12 to $13 range.
And the outrageous part.
The outrageous part, of course, is that you are betting heavily on perfect execution and regulatory certainty in a brand new sector that is absolutely famous for timeline slips and delays.
But if they manage to clear those hurdles with most of that $2 billion still in the bank, the reward for taking on that risk could be pretty substantial.
Precisely. It's a bet on their vertical integration strategy, overcoming the financial drag of their timeline.
So, to recap our deep dive, Archer isn't just building an aircraft anymore. They are aggressively building an entire aerospace platform. They're investing in the planes, in their own airports, and in future AI to try and lock down their lead in this pre-commercial industry.
And the final thought we'll leave you with is this. Buying a strategic asset like Hawthorne Airport is, it's an unprecedented infrastructure commitment. It might just unify the industry in a key market, but it came at a huge upfront cost. Will that ownership model accelerate them to market fast enough to justify that spending and satisfy investors before that 2028-2029 break-even target? That is the high-stakes challenge they face right now.